The hearing will now come to order. We welcome Chairman Powell back to the committee for the Federal Reserve's Semiannual Monetary Policy Report to Congress. In this hearing, the Banking Committee will evaluate the current state of the U.S. economy, the Fed's implementation of monetary policy, and discuss its supervisory and regulatory activities. In the last semi-annual monetary policy report, Chairman Powell provided additional clarity on the Fed's plans to normalize monetary policy, including how the size of the balance sheet would be driven by financial institutions' demand for reserves plus a buffer. Since then, the Fed has provided additional information and continued receiving feedback on its monetary policy strategy, tools, and communication, all of which I look forward to hearing an update on today. The U.S. economy is still strong, growing at 3.1% in the first quarter of 2019, according to the Bureau of Economic Analysis. And the unemployment rate remains low at 3.7% as of June, according to the Bureau of Labor Statistics. Wages have continued rising as well, with average hourly earnings 3.1% higher in June compared to a year earlier, which is the 11th straight month in which wage growth exceeded 3%, according to the Bureau of Labor Statistics. In fact, the U.S. is officially in its longest expansion of economic growth since 1854, according to the National Bureau of Economic Research. In order to continue this positive economic trajectory, regulators must continually evaluate their regulatory and supervisory activities for opportunities to tailor regulations and to ensure broad access to a wide variety of financial products and services. With respect to regulation and supervision, it's been over a year since the enactment of S-2155, the Economic Growth, Regulatory Relief, and Consumer Protection Act. Mr. Chairman, as you move forward in finalizing certain rules required under S-2155 and consider proposing new ones, I encourage you to consider carefully the following. Simplify capital rules for smaller financial institutions while ensuring they maintain significant capital by setting the community bank leverage ratio at 8%. Simplifying the Volcker rule, including by eliminating the proposed accounting prong and revising the covered funds definition's overly broad application to venture capital, other long-term investments, and loan creation to improve market liquidity and preserve access to diverse sources of capital for businesses. Harmonize margin requirements for inter-affiliate swaps with treatment by the CFTC by quickly making a targeted change to your margin rules to enhance end users' ability to hedge against risks in the marketplace. Examine whether the recent proposal that applies to U.S. operations of foreign banks is appropriately tailored and whether regulations on intermediate holding companies should be applied based on the assets of the intermediate holding company alone rather than the assets of all U.S. operations. I also encourage you to align the foreign bank proposal with the domestic bank proposal and exclude inter-affiliate transactions from each of the risk-based indicator calculations. Index any dollar-based thresholds in the tailoring proposals to grow over time to improve the rule's durability. And modernize the Community Reinvestment Act, CRA, to ensure that banks are not ignoring their mandate to serve their entire communities, which should include legal businesses that banks disfavor operating in their communities. A bank responding to political pressure or attempting to manage social policy by withholding access to credit from customers and/or companies that it disfavors is not meeting the credit needs of the entire community. These approaches would promote economic growth by ensuring that rules are balanced, work for all stakeholders, and do not unnecessarily impede access to financial products and services in the marketplace. On a different topic, Facebook announced it's partnering with both financial and non-financial institutions to launch a cryptocurrency-based payment system using its social network. The project has raised many questions among U.S. and global lawmakers and regulators, including about its potential systemic importance, consumer privacy, data privacy, and protection, and more. I'm particularly interested in its implications for individuals' data privacy. The Bank of England Governor Mark Carney said, Libra, if it achieves its ambitions, would be systemically important. As such, it would have to meet the highest standards of prudential regulation and consumer protection. It must address issues ranging from anti-money laundering to data protection to operational resilience. I look forward to hearing more about how the Fed, in coordination with other U.S. and global financial regulators, plans to engage on important regulatory and supervisory matters with Facebook throughout and after the project's development. While Libra's systemic importance depends on several factors in its future development, there are already some too-big-to-fail institutions that must be addressed: Fannie Mae and Freddie Mac. They continue to dominate the mortgage market and expose taxpayers in the case of an eventual downturn. In 2017 speech, you, Mr. Chairman, publicly referred to Fannie and Freddie as systemically important. Although my strong preference is for the comprehensive legislation the Banking Committee recently explored for one option for addressing Fannie and Freddie, which is the Financial Stability Oversight Council to designate Fannie or Freddie as systemically important financial institutions and to subject them to Fed supervision and enhanced prudential standards. Chairman Powell, I appreciate you joining the committee today to discuss these and many other important issues. And we'll now turn to Senator Brown.
Thank you, Mr. Chairman. And Chairman Powell, thank you for joining us and for your public service. The stock market is soaring, but most American families get their money from a paycheck, not an account statement from their stockbroker. A critical part of your job, Mr. Chairman, is measuring and evaluating the economy, and those measurements need to take into account workers, not just wealth. Talk to workers who haven't had a meaningful raise in years, who have seen their retirement cut, who watch their health premiums rise, who have seen the cost of their child care and their kids' college and paying off their own student loans going up and up and up. To those workers, to most Americans, the idea that a stock market rally means more money in their pockets is laughable. As the Fed's own data reveals, the economy hasn't helped most Americans. Corporate profits go up and up and up. Executive compensation explodes upwards. Workers are more and more productive but workers don't share in the wealth that they create. The top 1% have an average net worth of $24 million. The bottom half of all Americans each has about $20,000. That's 1/1,000th of their wealthiest neighbors. Meanwhile, the share of workers who have been unemployed for over 26 weeks continues to climb. Mitch McConnell and Donald Trump responded a year or so ago by giving the wealthiest Americans and multinational corporations a $2 trillion bonus. Those corporations turned around and funneled the money back to their executives through stock buybacks. We're in the midst of the longest economic expansion in modern times, beginning, frankly, around the time this committee decided to rescue the auto industry. We know interest rates are low, yet it's worrying that interest rate-sensitive sectors of the economy that provide good-paying jobs like the auto industry aren't doing better. Employment in auto manufacturing, critical to Ohio and the industrial Midwest, continued to fall in June. The Fed's policies should ensure that everyone who contributes to their economy also shares in the wealth that they create. All work has dignity. We need an economy that rewards and honors work, not just wealth. Some of the challenges facing our economy can only be addressed by Congress. Millions of Americans struggle to pay for prescription drugs, which are increasing at 5 times the rate of inflation, yet the White House looks like a retreat for drug company executives. Too many feel the squeeze of rising housing costs, with more than a quarter of renters spending over half their income on housing. The Fed can't fix all these issues on its own. Only Congress can. But there are things that you can and should do to help the economy work for the vast majority of Americans through careful monetary policy and doing your job of policing Wall Street. I appreciate, Mr. Chairman, your recent recognition that this expansion has the potential to benefit communities that have missed out on prior economic expansions. I hope your comments expressing frustration that wages haven't increased as much as you expected means you will take action. I urge you to continue with policies that both lower unemployment and increase wages. In previous hearings, I've raised concerns about threats to the financial system, including the Fed's steps to weaken the rules in the largest banks, the failure to activate the countercyclical capital buffer to prepare for the next financial crisis and the lack of action to address risks posed by leverage lending. Just this week, Deutsche Bank announced a significant restructuring, overhauling several businesses, cutting 18,000 jobs, almost 20% of its workforce. After several failed turnarounds in recent years, Deutsche Bank's latest effort shows it's too large and complex and has been mismanaged and under-regulated. It isn't the only mega bank in that situation. I continue to be concerned that the Fed and other banking regulators are not doing enough. I add a new worry today to the list: private corporations, Facebook in this case, that have gotten carried away with their own wealth and their own power and are now attempting to ape the role of government, creating their own currencies and monetary policy and payment systems. So now, in addition to complex and risky Wall Street banks, we face new risks from unregulated giant tech companies armed with vast amounts of personal data with the intent, as far as I can tell, of conducting monetary policy on their own terms. You and I have a duty to serve the American people, but these private corporations have no duty to the broader economy or consumers. They're motivated by one thing, surely their own bottom line. Allowing big tech companies to take over the payment system or position themselves to influence monetary policy would be a huge mistake and is surely a threat to our democracy. Too many times when the stock market soars and banks make money hand over fist, regulators have been complacent. As we've seen in the past, though, bank profitability is not a reliable indicator of banks' true health. The stock market is not a reliable indicator of the real economy's performance. I hope this is not another example of the Fed taking a pass from the responsibility to protect Americans from corporations taking big risks with our entire financial system. It's your responsibility, Mr. Chairman, to use your tools over monetary policy, the payment system, and prudential regulation to protect the financial system and make our economy work for all Americans, not just wealthy stockholders and huge corporations. Thank you for being here.
Thank you, Senator Brown. And again, thank you, Chairman Powell, for being here with us today. I would like to, before I turn the time over to Chairman Powell for his statement, I want to remind our colleagues that we have a vote at 3 votes at 11 o'clock. We obviously are not going to get through all the questions for all the senators here in that time frame. Senator Brown and I will try to rotate during that and keep the hearing going, but I would like to ask all of our senators to be careful, especially this time, to pay attention to your 5-minute term on your questions so that your colleagues can all have an opportunity to ask questions. With that, Chairman Powell, we look forward to your statement. Please proceed.
Thanks very much and good morning. Chairman Crapo, Ranking Member Brown, and members of the committee, I am pleased to present the Federal Reserve's Semiannual Monetary Policy Report to Congress. Let me start by saying that my colleagues and I strongly support the goals of maximum employment and price stability that Congress has set for monetary policy. We are committed to providing clear explanations about our policies and activities. Congress has given us an important degree of independence so that we can effectively pursue our statutory goals based on objective analysis and data. We appreciate that our independence brings with it an obligation for transparency so that you and the public can hold us accountable. Today, I will review the current economic situation and outlook before turning to monetary policy. I will also provide an update of our ongoing public review of our framework for setting monetary policy. The economy performed reasonably well over the first half of 2019, and the current expansion is now in its 11th year. However, inflation has been running below the FOMC's symmetric 2% objective, and cross-currents, such as trade tensions and concerns about global growth, have been weighing on economic activity and the outlook. The labor market remains healthy. Job gains averaged 172,000 per month from January through June. This number is lower than the average of 223,000 a month last year, but above the pace needed to provide jobs for new workers entering the labor force. Consequently, the unemployment rate moved down from 3.9% in December to 3.7% in June, close to its lowest level in 50 years. Job openings remain plentiful, and employers are increasingly willing to hire workers with fewer skills and train them. As a result, the benefits of a strong job market have been more widely shared in recent years. Indeed, wage gains have been greater for lower-skilled workers. That said, Individuals in some demographic groups and in certain parts of the country continue to face challenges. For example, unemployment rates for African Americans and Hispanics remain well above the rates for whites and Asians. Likewise, the share of the population with a job is higher in urban areas than in rural communities, and this gap has widened over the past decade. A box in the Monetary Policy Report provides a comparison of employment and wage gains over the current expansion for individuals with different levels of education. GDP increased at an annual rate of 3.1% in the first quarter of 2019, similar to last year's pace. This strong reading was driven largely by net exports and inventories, components that are not generally reliable indicators of ongoing momentum. The more reliable drivers of growth in the economy are consumer spending and business investment. While growth in consumer spending was weak in the first quarter, incoming data show that it has bounced back and is now running at a solid pace. However, growth in business investment seems to have slowed notably, and overall growth in the second quarter appears to have moderated. The slowdown in business fixed investment may reflect concerns about trade tensions and slower growth in the global economy. In addition, housing investment and manufacturing output declined in the first quarter and appear to have decreased again in the second quarter. After running close to our 2% objective over much of last year, overall consumer price inflation, measured by the 12-month change in the price index for personal consumption expenditures, or PCE inflation, declined earlier this year and stood at 1.5% in May. The 12-month change in core PCE inflation, which excludes food and energy prices and tends to be a better indicator of future inflation, has also come down this year and was 1.6% in May. Our baseline outlook is for economic growth to remain solid, labor markets to stay strong, and inflation to move back up over time to the committee's 2% objective. However, uncertainties about the outlook have increased in recent months. In particular, economic momentum appears to have slowed in some major foreign economies, and that weakness could affect the U.S. economy. Moreover, a number of government policy issues have yet to be resolved, including trade developments, the federal debt ceiling, and Brexit. And there is a risk that weak inflation will be even more persistent than we currently anticipate. We are carefully monitoring these developments, and we will continue to assess their implications for the U.S. economic outlook and inflation. The nation also continues to confront important longer-run challenges. Labor force participation by those in their prime working years is now lower in the United States than in most other nations with comparable economies. As I mentioned, there are troubling labor market disparities across demographic groups in different parts of the country. The relative stagnation of middle and lower incomes and low levels of upward mobility for lower income families are also ongoing concerns. In addition, finding ways to boost productivity growth, which leads to rising wages and living standards over the longer term, should remain a high national priority. And I remain concerned about the longer-term effects of high and rising federal debt, which can restrain private investment and, in turn, reduce productivity and overall economic growth. The longer-run vitality of the U.S. economy would benefit from efforts to address these issues. Against this backdrop, the FOMC maintained the target range for the federal funds rate at 2.25% to 2.5% in the first half of this year. At our January, March, and May meetings, we stated that we would be patient as we determined what future adjustments to the federal funds rate might be appropriate to support our goals of maximum employment and price stability. At the time of our May meeting, we were mindful of the ongoing cross-currents from global growth and trade, but there was tentative evidence that these cross-currents were moderating. The latest data from China and Europe were encouraging, and there were reports of progress in trade negotiations with China. Our continued patient stance seemed appropriate, and the committee saw no strong case for adjusting our policy rate. Since our May meeting, however, these cross-currents have reemerged, creating greater uncertainty. Apparent progress on trade turned to greater uncertainty, and our contacts in business and agriculture report heightened concerns over trade developments. Growth indicators from around the world have disappointed on net, raising concerns that weakness in the global economy will continue to affect the U.S. economy. These concerns may have contributed to the drop in business confidence in some recent surveys and may have started to show through to incoming data. In our June meeting, we indicated that in light of increased uncertainties about the economic outlook and muted inflation pressures, We would closely monitor the implications of incoming information for the economic outlook and would act as appropriate to sustain the expansion. Many FOMC participants saw that the case for a somewhat more accommodative monetary policy had strengthened. Since then, based on incoming data and other developments, it appears that uncertainties around trade tensions and concerns about the strength of the global economy continue to weigh on the U.S. economic outlook. Inflation pressures remain muted. The FOMC has made a number of important decisions this year about our framework for implementing monetary policy and our plans for completing the reduction of the Fed's securities holdings. At our January meeting, we decided to continue to implement monetary policy using our current policy regime with ample reserves, and we emphasized that we are prepared to adjust any of the details for completing balance sheet normalization in light of economic and financial developments. At our March meeting, we communicated our intention to slow, starting in May, the decline in the Fed's aggregate securities holdings and to end the reduction in these holdings in September. The July Monetary Policy Report provides details on these decisions. The report also includes an update on monetary policy rules. The FOMC routinely looks at monetary policy rules that recommend a level for the federal funds rate based on inflation and unemployment rates. I continue to find these rules helpful, although using these rules requires careful judgment. We're conducting a public review of our monetary policy strategy, tools, and communications, the first review of its kind for the FOMC. Our motivation is to consider ways to improve the committee's current policy framework and to best position the Fed to achieve maximum employment and price stability. The review has started with outreach to and consultation with a broad range of people and groups through a series of Fed Listens events. The FOMC will consider questions related to the review at upcoming meetings, and we will publicly report the outcome of our discussions. Thank you, and I'm happy to respond to your questions.
Thank you very much, Chairman Powell. I'm going to use my time to focus on the question of cryptocurrency and the development of the new cryptocurrency payment system by Facebook and its partners. The Federal Reserve has played a significant role in overseeing data protection and privacy across the U.S. financial system, including payments. Cryptocurrency payments, particularly those based on blockchain technology, pose a number of new challenges for data protection and privacy and the effective oversight of those issues. I'm sure that the members of the Federal Reserve have been looking at this, and I'd just be interested in what your understanding at this point is of how the Federal Reserve's role for data protection and privacy with respect to traditional financial services can be applied to Libra and Calibra.
Thank you, Mr. Chairman. I guess I'd start by saying that we do support responsible private sector innovation in the financial system, as long as that's carried out in a way that addresses the associated risks and preserves safety and soundness. The project sponsors hold out the possibility of public benefits, including greater access to the financial system for some, but I think we agree that Libra raises a lot of serious concerns, and those would include around privacy, money laundering, consumer protection, financial stability, and those are going to need to be thoroughly and publicly assessed and evaluated before this proceeds. And so we've set up a working group to focus on this at the Fed, and we're in contact with the other regulatory agencies. Indeed, we're in contact with central banks and governments around the world on this, and really just getting started. And I would just stress, I think it's a great thing that you're having a hearing on this, I guess, next week. I think this it's important that this process of understanding and evaluating this proposal be a patient one and not a sprint to implementation. In terms, you asked specifically about data privacy. One of the features of this project is you would want to see a particular regulatory body that has oversight over the whole project, and that doesn't appear to be the case. There isn't any one agency that can stand up and have oversight over this. We do not have oversight over Facebook. The privacy rules that we apply to banks, we have no authority to apply them to Facebook or to Libra or to Calibra or to the Libra Association. So We are just in the process of thinking this through, but I think one of the notable features of the project is that the supervision and regulation of it would fall in front of many different agencies, state, national, and international, and we need to get our arms around that for starters.
Well, thank you, and you've actually led into my second question on that. I was going to talk about how we fit in, all of our banking regulators, the SEC, FinCEN, CFPB, and frankly, going beyond even financial regulators to capture the entire scope of not just this, but many other aspects of the data collection that's going on in the global experience that we are having, the human experience we're having on the internet these days. Do you think that we need to look at the possibility of creating a new regulator dealing with data protection?
I think that is exactly the question we need to be focused on, one of the many questions we need to be focused on. It isn't obvious at all from our current regulatory system that we have in place what we need to assess and provide oversight over this. And I expect we'll be working hard on this and ideally working with your staff as we explore it.
Well, thank you, and I look forward to the. I'm glad to hear that you've got a working group together and that you're reaching out to other regulators who have a piece of this issue and of the broader issue of data collection, and look forward to working with you on this. Senator Brown.
Thank you, Mr. Chairman. Thank you for your questions about Facebook. Clearly, this alternative banking system clearly implicates monetary policy and payments and regulatory issues. Your concerns, I appreciate the concerns you expressed. Talk in a little more detail, if you would, Mr. Chair, about what kinds of risks this alternate Facebook currency would pose to ordinary people.
Well, I think you start with privacy. And the privacy of financial data. And then it moves quickly, I think, into the question of these things become, is the blockchain going to be so private that it becomes a vehicle for somehow evading money laundering rules and that kind of thing. So there's a balance to be struck there. In addition, the potential scale of this, given the size of Facebook's network, means it could be essentially immediately systemically important, and I think the company has acknowledged that. So that means, and I would echo what you quoted, Mr. Chairman, what Governor Carney said, that means that this should be subject to the highest level, the highest expectations in terms of privacy, but also prudential regulation. And the question is who's going to provide that and how and when, and I wish we had an easy answer, but that's the question.
You, in response to the chairman's question, mentioned you've been in touch with central bank, your counterparts in central banks. Can you tell me what you're hearing from them, whatever publicly you can tell us, what you're hearing from other central banks? I know China and Japan and Britain. Just your thoughts.
I think everyone wants to start with the proposition that we want there to be innovation in the financial system. We don't want to be, just reacting negatively to innovation. We want to find a way to incorporate it. But there just are serious concerns all around the table on how this will fit into our regulatory system and what it will really mean. And so I expect we'll be making quite a bit of progress. In fact, there's a G7 meeting, ministers and governors in Paris next week, and I know it will be a topic there. And so I think we're at the early stages, really, of understanding. I think we understand what's in the white paper and that sort of thing, but what are the right ways to assure that the public is protected and the financial system?
The working group that the two of you talked about, certainly let us know. Give us regular updates on where you're going and what you're suggesting. The Fed's latest monetary policy report says credit standards for new leverage loans are weak and have deteriorated further over the past 6 months. A slowdown in economic activity could pose risks to borrowing firms and their creditors. These borrowing firms are companies that employ millions of people, including many in the retail sector. How would a crash in the leverage lending market decrease economic activity, and how would it affect employment?
Well, I think the thought is that if the business sector, as a general matter, has a lot of debt, companies that are highly levered will be more affected by an economic downturn should one happen. They'll be more likely to cut back on capital expenditures and maybe hiring and that sort of thing. So highly levered companies are more vulnerable to economic shocks. And I think that is the nature of the risk we see around leveraged lending. We don't see it as akin to the risks that existed before the financial crisis, which were more risks to the financial system as such. Most of this risk is now held in market-based vehicles which have stable funding. Not all of it, but most of it is held in that. So it is really for us a macroeconomic risk. And we've called it out, and we've, we're looking hard at those vehicles and assuring that they do have stable funding, as we believe they do for the most part.
And we need you to pay special attention to those risks, as you know. Let me talk for a moment about CCAR. The Fed recently approved capital distributions from the largest banks. Not surprisingly, you can expect the largest banks will spend tens of billions of dollars rewarding themselves and their investors with dividends and stock buybacks. That's been their history. That's likely to be their future. This clearly doesn't help workers and consumers. Why does the Fed continue to approve these kind of exorbitant capital plans that direct so much money away from the real economy?
So the sense of the stress test is that after the shock that we apply, the global market shock in the case of many of the largest institutions, and then the economic shock to the others, the banks have to exceed certain minimum capital requirements even after this shock. And those requirements are higher than the actual level of capital that the banks had in 2007. So they're quite high, and the shocks are quite large. And the stronger the economy is, the bigger the shock is. That is their obligation. Above that, they can, if they have capital that's well in excess of that, or if they have, then they have the ability to pay dividends as long as they meet that test. It's a consequence of the fact that we've spent a decade with stress tests and requirements, having the banks raise their capital higher and higher and higher, and they now are in a position where they can pay out all of their earnings for that year and still be in compliance with the tests with a margin of error and a margin. So that's really where we are.
Thank you.
Senator Shelby.
Thank you, Mr. Chairman. Chairman Powell, thank you for your service. Thank you for your work to keep the Federal Reserve independent of both parties and do your job for what it was set up to be. We salute you for that. Several things you've touched on. Mr. Chairman, before I get into a few questions, I'll try to stay within the 5 minutes. I have a number of questions I'd like to ask for the record, without objection, if you would.
Without objection.
Thank you. You mentioned trade as a cloud, perhaps, on the economy, some certainty there. We all know the economy is the best that I've seen in my lifetime at the moment. We want to sustain that. Trade is one way to sustain it if we have certainty there. That's not the only one. Would you elaborate on that, how important that is to the economy?
I will. I should start by saying that we, of course, play no role in setting trade policy, and please, no one should construe anything we say about trade as...
But it affects what we do in the economy,
yes,
does it not?
But it shouldn't be construed as in any way a criticism, because those are assigned to you and to the administration. But what we get from our business context, and I imagine this is fairly widely the same as what you're hearing, is if you're a manufacturing company in the United States these days of any size, you've probably got a supply chain that goes across international lines. And that's a really important part of your business. And so the trade negotiations that have been going on have injected uncertainty for those businesses into their supply chain. So many of them have moved their supply chains. Some moved them to Mexico and then found that Mexico might be the target of tariffs. Others are considering what to do. In any case, it's at a minimum, it's a distraction from going out there and rolling out new products and that sort of thing. And so it shows up a lot in the Beige Book, just overall concerns, and I think it's weighing on the outlook. It does seem to be weighing on the outlook. We see weakness in manufacturing and investment and trade in the United States, and that's where it shows up.
Your mandate as Chairman of the Fed is to do what you can for full employment and also price stability. Sometimes you got to balance that, as we all know. It's very important for our monetary system, and I think overall you're doing a good job on that. I do worry down the road about inflation, as you do, and so forth. It seems to be fairly tame at the moment, and so forth. but we've observed in the past that there has been some type of relationship in previous years between inflation rates and unemployment rates. As unemployment goes way down, more jobs, there's pressure on wages and salaries and so forth. Is there a new paradigm out there as far as evaluating this today, and is it because of the global economy, or what is it? Because we have low unemployment, but we have, at the moment, not a lot of pressure from your testimony and what we observe on inflation.
So the relationship between slack in the economy, or unemployment, and inflation was a strong one 50 years ago. If you remember that in the 60s, there was a close correlation there, and that has gone away, and it's really been
But we had a different economy then, did we not?
very different economy in so many ways. And this, in this way, that really, I would say that period, at least 20 years ago, that period was over, and the relationship between unemployment and inflation became weak. It's become weaker and weaker and weaker. In addition to that, I think we're learning that interest rates, that the neutral interest rate is lower than we had thought. And I think we're learning that the natural rate of unemployment is lower than we thought. So monetary policy hasn't been as accommodative as we had thought. So I think we're learning all of those things. At the end of the day, there has to be a connection, because low unemployment will drive wages up, and ultimately higher wages will drive inflation, but we haven't reached that point. And in any case, the connection between the two is quite small these days.
What's your take on the ability for the German nation to borrow money, their bond, at a lower rate than we do? Say a 10-year bond. Is it based on what we traditionally know in economics, the least likelihood of default, or what is that? Because they're borrowing money around 2% lower than we are.
I think it's a range of factors, and I wouldn't know them for sure, but I would say it's low inflation in Europe that goes into rates. It's also the amount of quantitative easing and asset purchases that the European Central Bank has done. It's also expectations of slower growth. All of those things I think go into driving those extraordinarily low European sovereign rates.
Thank you, Mr. Chairman.
Thank you. Senator Menendez.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for your service. During your testimony in front of the House Financial Services Committee, you stated that any problems that could emerge through Libra would, quote, arise to systemically important levels just because of the mere size of Facebook. So is Facebook simply too big to build its own digital currency?
I think it's too early to say that. I think we're at the beginning of assessing that. But I think the size of their network does focus your attention on the very likely systemic importance of this currency, and that doesn't mean they shouldn't do it. But it means that at a minimum, it means that the standards that need to be applied to it will be the highest.
Mm-hmm. And as such, then, if Libra moves forward, is it possible that our concerns rise that we will have another too-big-to-fail institution tethered to the U.S. economy?
I certainly hope not, Senator. Again, we're at the very beginning of assessing all this, and I don't know that this would be that Facebook itself. I mean, Libra is actually 28 companies, including Facebook. I don't know that that Facebook would be too big to fail, no matter what happens with Libra.
Yeah, I was referring to Libra. Let me ask you about this. If Libra moves forward as a cryptocurrency, should FSOC consider classifying Libra as a non-bank SIFI?
It's a very good question. I know the FSOC will be focusing on this. Again, we haven't had a principals meeting at FSOC since this was announced. There have been staff level meetings on it, though. So we'll be focusing on it. It's the Treasury Secretary's lead there. He's the chair.
Yeah, but I would assume you would have some comments and say on that.
Absolutely.
Look forward to seeing how that evolves. Chairman Powell, we've seen what happens in countries like Venezuela when central banks stop making decisions based on economic data and instead change monetary policy to suit the political goals of those in power. The results are pretty ugly. Now, of course, I don't always think the Fed gets things right, but our system is infinitely superior to one where the president dictates interest rates, especially when we're heading into elections. President Trump has on several occasions threatened to either fire or demote you in what is clearly an attempt to intimidate you into taking certain actions. And I think I speak for all of my colleagues when I say that we applaud your efforts to keep the Federal Reserve as an independent and nonpartisan institution. So in your monetary policy report, you talk a lot about how uncertainty is holding back economic growth. Is it fair to say that the President's comments about you and the Fed's monetary policy decisions are contributing to that uncertainty?
I'd be reluctant to address that. I think we're really referring to uncertainties around trade and global growth in what we said in the monetary policy report.
Okay. So then let's turn to that. If it's trade and monetary, if it's trade, you noted several times that uncertainty over trade policy is weighing on the economy. And I can tell you not a week goes by that I don't hear from folks in New Jersey that they are fighting it harder and harder to grow their businesses and hire more workers because of the administration's unpredictable trade policy. So when you talk about quote-unquote uncertainty in trade policy, isn't what you're really talking about is the President's unpredictable behavior and his obsession with tariffs, which are really just taxes on Americans? Probably the most stark example of this is when the President put tens of thousands of American jobs at risk by threatening tariffs on Mexico to address an issue completely unrelated to trade. Would you agree that threatening to put tariffs on imports from the second largest trading partner in the world on an issue completely unrelated to trade has increased uncertainty and held back our economy in the past few months?
I think businesses, like people, like a settled rule book. They like to know what the rules are so that they can act as aggressively or carefully as they want to. And I think when you go through a series of trade negotiations with your major trading partners, inevitably there will be uncertainty around that. Again, that's not to judge whether these conversations in any way, not to judge them in any way, but
no, but I'm not
I think
talking
that's
about,
what it is.
excuse me, Mr. Chairman, I'm not talking about trading negotiations in general. I'm talking about using tariffs for non-trade purposes. That creates uncertainty. Every CEO I had when we were talking about tax reform, they would say to me, "Now, well, regardless of what policy you come up with, give me predictability and certainty, and I'll figure out a way to make money." Certainly, it becomes enormously unpredictable when tariffs are used for non-trade issues.
I think that the reaction to that was actually pretty strong in the business community.
Thank you.
Senator Toomey.
Thank you, Mr. Chairman. Welcome back, Mr. Chairman. Good to see you here. I just want to follow up a little bit on a point that Senator Menendez was making. I, too, observed parts of your testimony before the House Financial Services Committee yesterday, and I noted that you were asked whether you intend to serve out the entirety of your term, and you said that you definitely are intending to do that. And I want to say I, for one, am glad to hear that that's your conclusion, in part because I do think it's important that the Fed remain insulated from political pressure. But I also want to say, for the record, that I think you've done an outstanding job. I would remind my colleagues, on the day that you were sworn in, the Fed funds rate was still, on a real basis, very close to zero. We had an enormous balance sheet. We had not yet exited the extremely abnormal monetary policy that we had pursued for about a decade. And I think that was a very dangerous experiment. And the unwind of that had no roadmap. There was no precedent. We had never experienced this before. And the central banks in other parts of the world were not in the process of normalizing. And so you had to figure out a way to do that because I think you believed that it was important to normalize. And you went about doing that, and we went about doing some things on our side. We did major tax reform. We rolled back some regulation that we thought was excessive. And what's the result? What are the results of that work? The result is the strongest economy of my lifetime. 3% economic growth last year, 3% in the first quarter of this year, record low unemployment, record job creation. We now have more job openings than we have people looking for work. We helped to expand the productive capacity of the economy. The economy's responded tremendously. And now we're seeing an acceleration of wage gains, which are strongest at the low end of the income spectrum. So this policy and this economy is narrowing the income gap, the wealth gap. And Mr. Chairman, we used to have an expression for an economy like this. We used to call it the Goldilocks economy, right? Strong growth, very low unemployment, rising wages, and very low inflation. That's exactly what you hope for in an economy. So I'm not suggesting you get all the credit for it. We certainly don't get all the credit for it. But you were able to normalize from this very strange experiment. And here we are with some terrific consequences. That leads me to my question. In light of the strength, the fundamental strengths of the economy as I see them, and I acknowledge that there are doubts and uncertainties, there always are. But I have to confess I've been a little surprised to see over recent weeks that the market has estimated about a 100% certainty that we're going to get a reduction in the Fed funds rate. I'm not asking you to tell us what the committee is going to decide to do at the end of this month. But in light of the strength, the fundamental strength, it's surprising to me the breadth of the consensus that we're going to lower interest rates. And one of the things that I wonder about is, to what extent is this driven by market-driven interest rates? So as you know, virtually the entire Treasury yield curve is trading below the Fed funds rate. I think you got to go out to the 20-year maturity to get close to where Fed funds are. And maybe that's the private market telling us that the price of money should be lower than it is. And I just wonder how you think about the fixed income markets, especially the Treasury markets. To what extent does that influence the judgment of you and your colleagues in determining where interest rates should be?
Thank you, Senator. So we see it quite similarly to the way you described it. The U.S. economy is in a very good place, but we also see those uncertainties I mentioned as weighing on the outlook, and we also see some weakness in the United States economy that I've mentioned: housing, manufacturing, trade. And I think you know, we have signaled, and central banks around the world are seeing weakness everywhere, and they're also providing more accommodation. We've signaled that we're open to doing that, and you're seeing that in the curve now. You're seeing that embedded in the United States interest rate curve. The fact that we have said that we're going to do that.
It seemed to me that the yield curve was suggesting that even before there was a change in the tone.
So what does that reflect? I think it reflected the real concerns that arose really beginning in May. You saw business confidence surveys gapping out and you know, quite negative fairly broadly. It was a bit of a confidence shock. Now, I think some of that has recovered, but that in part is because we have stepped forward and indicated that we're, you know, that's what happens is we address that through our policy and indicate at our last meeting that we were looking at changing rates. I mean, the bottom line is the economy is in a very good place, and we want to use our tools to keep it there. It's very important that this expansion continue as long as possible.
Thank you very much, Mr. Chairman.
Thank you. Senator Tester.
Thank you, Mr. Chairman. Ranking Member Brown, I also want to echo what many of the members have said already, and thank you for the job you're doing, Chairman Powell. I very, very much appreciate it. I think I'm going to start here. It was in 07 or 08 that we had a hearing in here with the Secretary of Treasury when he said that we were on the cusp of a total financial meltdown. We're looking at an economy that is flying right along. We're racking up debt of $1 trillion a year. We've got a president that puts tariffs on at whims without any exit strategy with the tariffs. We've got allies that have been pushed away. We're witnessing China's influence internationally that's been incredible, and plus their investment in infrastructure in their own country. We're seeing health care becoming unaffordable. We're seeing higher education being unaffordable. And we've invested virtually nothing in infrastructure in this country, especially when we look at a 21st century economy. I remember that hearing that we had in this banking committee very, very vividly, because The question I asked of the Treasury is how come we hear about this when it is such a crisis situation that we're looking at a financial meltdown situation worldwide? And he had been in front of our committee. You are not Secretary of Treasury, but you have a very important job. He had been in front of our committee before and never said a word about it. So my question to you is, since your job is very, very important in looking at the underlying factors, what is the thing that you're looking at, or 2 or 3 things that you're looking at that would tip the scale? Because I think there's a lot of things going on right now that is very concerning. Even as we talk about low unemployment, we also fail to mention the fact that many of these families have to work multiple jobs to be able to afford even to rent a house. So could you tell me what the underlying factors that you're looking at that would give me assurance that this strong economy is actually as strong as we think it is?
In terms of our economy in the near and medium term, I think we really are in a good place. Mainly the consumer part of the economy is pretty much intact. That's 70% of the economy. You've got low unemployment, you've got good job creation, you've got rising wages, you've got people spending. All of that is, housing is more or less sideways, and you don't see sort of the kind of risky problems that you saw before the crisis. So those are all good things. You see some weakness in the business sector here, and that's really tied to manufacturing around the globe. That is the thing that I worry about. Is you see if you talk to international economic authorities, people are very concerned about global growth, and we will feel that over time. So I would say that's the main thing I worry about. The other thing I worry about, and I mentioned some of these, is just the longer run issues that we face as a country. We don't want to be at the bottom of the league table on labor force participation by prime age workers. We don't want to have an opioid problem that keeps
That's correct. Yeah.
I mean,
so I guess that there are a lot of things out there that are cruising along as we look at it, and I will tell you that the infusion of $1 trillion off the credit card every year into this economy, I would say has a pretty significant effect on its ability to grow. You give me $20,000 a year extra, I guarantee I'm going to spend more money and things are going to happen, but I got to pay that off at some point in time. Does the debt come into this equation at all? And then if you want to address the debt limit potential playing games with that, you could address that too.
household debt is actually in the
I'm talking about national debt.
National debt, that's different. Yeah, no, I would say the United States federal budget is on an unsustainable path. I think we all know that, and it's something that will have to be addressed. At the same time, we're the world's reserve currency. We borrow very cheaply, and there's no competitor really at the current time frame as in terms of another reserve currency. So what will happen, I think, is we'll just spend more and more of our precious resources paying interest on debt as opposed to investing in the stuff that we really need.
Okay, I'm out of time. Thank you very much. I do have some questions for the record, and I want to talk about the impact that these tariffs are having on ag and what you're seeing with the bigger banks and the smaller banks. But thank you for being here, Chairman Powell.
Senator Cotton.
Welcome back, Mr. Chairman. Last time you were here, we spoke about the labor share of income and why more profits aren't going down to regular workers. Today, I'd like to explore a related concept on economic mobility on that front. I'd like to say that I'm pleased to be chairing next week a hearing of the Economic Policy Subcommittee with Senator Cortez Masto, the ranking member, on economic mobility and whether the American dream is in crisis. There was an interesting article today in the Wall Street Journal, based in part on your semi-annual report, that mentions the record expansion surprise winner, the low-skilled, and it talks about how so many people who had been on the sidelines have gotten back into the economy, including some of the groups that you've mentioned that traditionally have been hurt the worst in recessions, minorities or the youth, disabled, and so forth. But it also says that it takes, on average, 8 years for less educated workers to recover the wages they lost in a recession. That's much shorter for college-educated or even those more highly educated. So, Mr. Chairman, I want to get your take on whether upward mobility depends in part on strong economic recoveries making it all the way into the 8th or even the 9th inning, so to speak. And are we currently in that state of this recovery, the 8th or the 9th inning, maybe even in extra innings?
The good news is, I think that we are in those innings and we are seeing that, and it's very gratifying to speak to people in low and moderate income communities who work there or live there or both, and have them say that they haven't seen a labor market like this really ever. And it's very, very tight, and that means employers are looking through all kinds of blemishes on resumes and hiring people, and they're training people up and things like that. So that's really good. That's the good news. The bad news is, as that box indicates, that started about 8 years into this recovery. So that isn't really a great national strategy, is to wait 8 years into it. We don't have that many recoveries, expansions rather. We need, we need a better strategy than that, because it's working now, but ultimately, the last time we had an expansion this long was 50 years ago. They don't tend to last this long. It also underscores, again, how important it is for us to keep this going, because a couple of more years of this, it's going to be very beneficial to those communities.
So I want to highlight your remarks a couple months ago at a Federal Reserve conference. You noted that the widening gap in economic status and prospects between those without a college degree and those with a college degree and those without one. So I'll quote more directly from your speech to illustrate just how wide that gap has become. In the 1960s, well over 90% of working-age men held a job, and there was very little difference in employment between those with or without a college degree. While the share of college-educated working-age men with a job has fallen from more than 95% in 1967 to around 90% in 2017, it has plunged for others. 95% of male high school graduates were working in 1967, but only about 80% of them were working in 2017. Among working-age men without a high school diploma, about 90% had a job in 1967 versus a bit more than 70% in 2017. That is a pretty stark difference between men with a college degree on one hand and men without one on the other hand. What, in your opinion, explains this new situation, Mr. Chairman?
So the way I think about this is that what's really a couple of major trends have been happening, and those are really globalization and the advance of technology. And for many of us, both of those things are advantages. If you're on the right side of those trends, probably this is the best time in human history for you. But there are people who, because they don't have the training and the skills and the background to benefit from advancing technology, then they fall on the other side of the divide, and that's what you're seeing. You're seeing similar patterns, maybe not as extreme, but similar patterns in other advanced economies that have faced the same challenges. So at the end of the day, it comes down to an educational system and a society that produces people who have the skills and aptitudes to benefit from technology, increasing technology, more complicated technology. And when you have that, you can have declining inequality and widespread prosperity. Without it, it will be very hard to achieve.
Sounds to me like if, say, China had a completely open market for American manufactured goods for the last 30 years, but completely foreclosed the American market in investment banking and management consulting, we might be hearing a different tune out of those who are on the right side of globalization right now. I won't ask you to comment on it, though. I will note, though, that I think immigration plays an important role here. In the period of time you were talking about, from the 1950s to the late 1990s, less than 10% of the American workforce was foreign-born. Right now, we are reaching a point of our highest in over a century. And I think it's important that we focus on immigration policy, too, as a role that it plays in blue-collar, working-class jobs, something we'll explore next week on the economic subcommittee. Thank you.
Senator Warner.
Thank you. Mr. Chairman, it's good to see you again. Again, editorial comment first. I was proud to support you when you became chair. You made a commitment to me that you would realize this job and role required an independent Fed chair that would not be subject to political lobbying and haranguing, whether it comes from this end of Pennsylvania Avenue or the other end. I think you've stuck to your guns so far, but I want you to keep sticking to your guns. I'd like to turn to some questions about Facebook and its proposed cryptocurrency, Libra. I'm a supporter of innovation in the financial sector, and if done right, this notion of a cryptocurrency could really deliver, I think, real benefits for increased friction, more access for consumers. But I also got to tell you, as somebody who's spent a lot of time in the last couple of years dealing with social media and Facebook in particular, I think it'd be safe to say, and frankly for people on both sides of the aisle, that Facebook has developed something of a trust deficit, and that the kind of Silicon Valley mindset of move fast and break things maybe works when you're just thinking about it in a technology framework, but when we're thinking about the kind of implications social media has had around consumer privacy, public discourse, that break things and move fast, no regulation doesn't always work. Now, yesterday, I think at the House Financial Services Committee, you noted that Libra posed many serious concerns, quote unquote, including potential risk of the stability of the financial system. And again, while I'm open to the public benefits, I share your concerns about systemic risk, money laundering, privacy, other items. This past week, former FDIC Chair Sheila Bair called on the Fed to exercise additional oversight over Libra. Possibility if this currency is fully built out, and particularly if Calibra, which would be the Facebook wallet in Libra, the ability to have credit disruptions, consumer losses, foreign currency risks, financial mismanagement of the Libra reserve. The truth is, we could be creating a system that, without the kind of regulatory oversight that led to the gaps that the crisis that took place, as Senator Tester pointed out. I think back about when the reserve fund broke the buck. We didn't think that was going to be the thing that potentially brought down the system, but you could end up with that same circumstances around Libra. Can you expound a little bit on what you see around these regulatory risks, and do you basically share Sheila Bair's concerns regarding the liquidity risks presented by Libra?
I do. I think the risks are, I think we need to do a very careful, patient, thorough assessment of what the risks really are. And I think that's going to take a little bit of time. And the idea that this would be going into implementation within 12 months, I think, is not going to be proven right. I think we're going to take more time than that. And as I mentioned earlier, one of the key issues really is that there isn't a single credible regulatory authority that can be responsible for oversight and held accountable for its oversight. It falls into many, many pockets, state, federal, international. So we're going to be looking at that. I did see that op-ed. I thought that was an interesting idea. I wouldn't want to prejudge what we do, where we come out. We really haven't even kind of gotten to the basics yet. But
my hope would be, though, that you would, we've not been great recently at getting things across the finish line. My hope would be that you would, take a serious look here. I think back to concerns I have back in the late 90s when social media was set up. I was a telecom guy. And the rules of the road that were set up were basically thinking, social media, these are just dumb pipes. We're not going to put any regulatory structure around it. We're now 20 years later. 65% of Americans get their news from Facebook and Google. We have the ability to disrupt our democratic processes. We see hate speech from either end of the political spectrum being brought forward. I would be really concerned as we think about the innovation that comes from this space, that we don't make the same exact mistakes back in the late 90s, that if we do move forward with this innovation, that we ensure, whether it's Facebook or any other dominant players, that we make sure that there really is going to be access for third-party wallets, not just a Facebook product, that we really think about the ability for third-party developers to plug into this new financial system. Getting this right on the front end is so terribly important, and I look forward to trying to work with you and the other regulators to make sure we get it right.
thank you. And I will just say this has gotten people's attention in a way that is I hope that's very clear, not just ours, but the other regulatory agencies and governments and similar bodies around the world.
I will say that my time's up, but Facebook has taken advantage of the gaps within the current system, and we got to make sure we don't have those gaps if we're going to talk about a whole new financial system. Thank you, Mr. Chairman.
Senator Rounds.
Thank you, Mr. Chairman. Chairman Powell, first of all, thank you very much for being here today. Before I begin my questions, I just wanted to comment on the insurance capital standard being developed by the IAIS. think my colleague from Wisconsin, Congressman Stile, hit it on the nail, or hit the nail on the head yesterday in his conversation with you, in which he made it very clear that any version of the ICS that fails to recognize the aggregation method in the United States is simply unacceptable, and I appreciated your comments basically agreeing with that it's got to work for us too. I also appreciated the response from Vice Chairman Quarles to the Senate letter that I led on this issue, but I remain concerned that the EU is using the ICS as a backdoor to implement its Solvency II insurance capital framework worldwide. The EU's insurance regulator took a victory lap at the end of their latest annual report, saying that they have achieved their goal of having, and I quote, Solvency II as the practical implementation of the ICS. So moving forward, it's imperative that we see a very strong, assertive response from the Fed and from Team USA to the IAIS activity. My first question concerns the capital plans that banks are required to develop under the CCAR framework. The CEO of J.P. Morgan, one of the banks required to participate in CCAR, said something about CCAR in his annual shareholders letter that I found rather striking. According to Mr. Diamond, and I quote, under the Fed's most extreme stress testing scenario, where 35 of the largest American banks bear extreme losses, the combined losses are about 6% of the total loss-absorbing resources of those 35 banks. J.P. Morgan Chase alone has nearly 3 times the loss-absorbing resources to cover the projected losses of all of these 35 banks. Mr. Chairman, it seems a little absurd to me that we're forcing an institution like J.P. Morgan to hold not just enough capital to cover its own losses, but also the losses of the other 35 largest institutions 3 times over. This is coming at a tremendous opportunity cost, in my opinion. The capital tied up under CCAR is capital that could be deployed to help first-time home buyers purchase a home or budding Main Street entrepreneurs start a small business. Vice Chairman Quarles said at a conference in Boston earlier this week that capital stress tests need to be more predictable and easier for firms to pass. I guess my question would be, do you agree that CCAR framework should be revised? Is it an item which is up for debate?
Well, I think that we're going to have to continue to change the tests will have to evolve over time, or they will inevitably, like anything else, they'll become out of touch with the reality. So we're committed to making appropriate changes. I would say, though, that the bank's obligation is to have a minimum level of capital post-stress, and they're going to want to have a buffer on top of that. That's the test they have to pass. And we don't want them to be able to go, we've made a pretty good judgment about what that minimum amount would be. I think the level of capital in the system is just about right. I do not think that it should be less, particularly for the largest banks. I don't believe that. I think there lots of work going on CCAR, though, and it was the subject of that conference in Boston on, I guess, Monday or Tuesday. Lots of changes, but again, we're going to preserve the overall strength and power of them while making them more transparent.
Yeah, and look, I appreciate that, and I understand that the capital requirements are important. It just seemed a little surprising to me what the current guidelines would do in terms of the amount of capital they are, and I think there is a cost when you maintain that versus being able to put that back out in terms of loans to places that need it. And I recognize that this is something which is ongoing, but I just want to point out that seems to me to be a little bit larger than what I would ever have expected it to be in terms of the capabilities today.
Well, again, I think the level of capital that we have required in them, of the largest institutions in particular, is about right, and it's high. It is high. It hasn't even been 10 years since the financial crisis. We haven't even been through a downturn. So I think it's early to be talking about reducing those standards.
Okay. One other question. In the Semiannual Monetary Policy Report, you point out that credit provided by commercial banks to fund businesses, as well as commercial and residential real estate, continue to grow in 2019, and that bank profitability remains solid in the first quarter of 2019. I was encouraged to read this because the pressures that farmers are facing due to our trade disputes and other headwinds have led to questions about whether or not banks will continue to continue to be able to make loans in the ag sector. given your view of the economy, should banks be in a position to continue to provide credit to farmers and ranchers during this time in which net farm income is down 50% in the last 5 years?
Well, and the answer is yes to that. I think our Farm Belt banks have had a lot of experience in dealing with the issues that farmers are confronting right now. I know the whole agricultural sector is in a difficult place. It's a tough time, and I know that banks are trying to work through those difficulties with farmers.
Very good. Thank you, Mr. Chairman. Appreciate the work you're doing. Thank you, Mr. Chairman.
Thank you.
Senator Schatz.
Thank you, Chairman. Chairman Powell, thank you for being here. I'm going to ask you a series of questions about severe weather and climate change. And the first thing I want to say is that I don't expect monetary policy to solve a public policy problem, but I do think it's important in your prudential supervision capacity that you measure risk accurately and completely. And so the first question I have is, does increased severe weather pose a risk to the institutions that you supervise?
Yes, I mean, and you know this, Senator, we do require financial institutions that we supervise to have a plan and an understanding to deal with severe weather events, particularly those that are in areas that are exposed to increased risk of severe weather.
Is severe weather increasing due to climate change?
I believe it is, yes.
Has the Fed changed the approach that it uses in assessing severe weather risk over the last 10 or 20 years?
We've had a policy in place. I would tell you there's been quite a lot of research done at the Fed around severe weather and its effect on the economy, and we do incorporate that into our supervision of these institutions, so it's definitely evolved. I think we have a, cutting-edge understanding of the effect of severe weather events on the economy, and we do incorporate that into our supervision.
But has the process changed?
Has the process changed? I'd have to go back and look.
And the reason I'm asking this specific question is that severe weather, generally speaking, over the last 10 or 20 years has been treated sort of force majeure. It can't be helped, and to a certain extent, it can't be accounted for, except that there's this sort of outside risk. But when that risk, say, of a 500-year storm rises 10x in, say, 15 years, then the question becomes, are your systems adequate to the conditions on the ground? And I can take that for the record if you don't want to puzzle through it.
No, I can. I mean,
mic'd up. Go ahead.
One way to get at that is to go back to Superstorm Sandy. In a world where you have water lapping at the foot of the New York Fed, which is not that close to the water, in downtown Manhattan, you know that you're going to need robust plans and redundancy and all those things to deal with severe weather events. And that happened in, 2013 or 14. So we know that, and we do apply very high standards to the key payment utilities and other financial institutions.
Let me read you something from the Bank of England. The costs of climate change are having a devastating effect. As financial policymakers and prudential supervisors, we cannot ignore the obvious risks before our eyes. We must integrate the monitoring of climate-related financial risks into the day-to-day supervisory work, financial stability, monitoring, and board risk management. Do you agree with the Bank of England?
I guess I see climate change as a longer-run issue. I don't know that incorporating into the day-to-day supervision of financial institutions would add much value. We have lots of things to supervise them for.
Let me make the case for day-to-day supervision, especially prudential supervision. You measure cybersecurity risk, political risk, balance sheet risk. You measure risk. This risk is accelerating. And I understand the desire for the Fed to sort of stay out of the political fray and even to stay out of the public policy fray. But this risk is accelerating, and I am satisfied that you're puzzling through this and that the staff is trying to get this right, but I am not satisfied that you are drawing the correct distinctions between weather and climate, and that you're adequately accounting for the increased frequency and severity of severe weather events due to climate change. And there's one other part of climate change. It's not just individual events. It's changes in weather patterns that could cause individual portfolios to be more at risk. And so do I have your commitment to continue to work with our office on this problem, especially given that, as you know, more than a dozen central banks around the planet are working really hard on this, and again, without an ideological lens, but just to try to adequately measure the risk?
Yes, and I'll also say there's really nothing going on in the other central banks that we're not quite well aware of, as I think you know.
Thank you.
Thank you.
Senator Perdue.
Mr. Chairman, good to see you again. Thank you for your forbearance, your second day going through this. I'd like to go back to a topic that we covered just a little bit earlier. Today, we have in the world about 60, directionally correct, about $60 trillion of sovereign debt. The United States has about 22 of that. Corporate debt since 2008 in the United States, between the last decade, between 08 and 18, about doubled, but still only represents about 4% of more than $60 trillion in overall U.S. capital market assets. My question is basically, after reviewing all the data around corporate debt, sovereign debt, and particularly the increase in corporate debt, do you believe that leverage lending has reached a point where it's beginning to be a systemic risk? If so, can you explain what information you're using to look at that?
So as far as corporate debt is concerned, I would tell you I do not see it as rising to the level of a systemic risk, and or a financial stability risk, which we think of as something that could threaten the functioning of the financial system. And the reason is a couple of things. First, the risk is really held in more than half of the risk in leveraged lending is held in collateralized loan and debt obligations, and those are market-based vehicles. They're not on the balance sheet of banks, and they're not runnable. I mean, it was runs during the crisis that caused a lot of damage. The funding for those vehicles has a longer expected life than the assets that they own. So that's an important thing. The next biggest holder of that paper is mutual funds, and those, in theory, could be subject to accelerated withdrawals and that kind of thing. We monitor that very carefully. There is a risk there, but we've seen them weather lots of downturns. So just empirically, we've seen them weather spikes in volatility and that kind of thing. We are not in any way backing away from this and saying it's not a problem. I mean, I think we're very focused on monitoring it and confirming that it doesn't evolve into something that could threaten the system. And in the meantime, it clearly can be an amplifier to an unexpected macroeconomic downturn.
You know, I tried to buy a cup of coffee in China last year with a credit card and with cash, and you just couldn't do it. So it was all, Alipay, WePay, et cetera. With the cryptocurrency question you had earlier and all the technology that's coming, it just seems to me that technology is running ahead of us in our ability to look at how currency is managed around the world, how cash flows are managed, and the impact that it could have on how we, for the last 100 years or so, have used reserve currency in the world, and we've benefited that in the United States. The ability to borrow $22 trillion of debt and potentially $10 trillion more over the next decade depends heavily on our ability to be the reserve currency, have the dollar as a reserve currency. What risk to the structure itself, and then also to the fact that the dollar's enjoyed for over 100 years now, or about 100 years, being the reserve currency?
You know, I think being the reserve currency does confer benefits and costs, and one of those is that one of the potential costs is that you're sort of a little bit immune from market discipline, because everyone wants to be in the most liquid asset, and it tends to be a pretty stable equilibrium. So there tends to be one reserve currency or two, and it tends to last for a long time. But if you're going to keep that role, you've got to run your fiscal house successfully. You've got to be running a sustainable fiscal policy. We're not. I don't think in the near term there's anything to threaten our status as reserve currency, but in the medium and longer term, we'll have to address our fiscal issues.
With $30 trillion in a decade, and that would be approaching probably 40 to 50% of all sovereign debt in the world at that point, because a lot of other countries are deleveraging to some degree. All of a sudden, then, that does, your medium to long term, I'm not trying to get you to quantify that, but if you look at the next decade and we're going to add 50%, if we were to add 50% more, that near to the long-term definition probably could fall in within the next decade or so, could it not?
Well, you have to have another reserve currency that has more attractive features. So we have we have the rule of law. We have institutions. We're a trading nation. We're open to trade. And we have a highly developed financial system. That's really important because when you're the reserve currency, you can have inflows and outflows, and you've got to have a financial sector that can absorb and manage that, or you'll have spikes in inflation and currency volatility and that kind of thing. So another currency would have to emerge that could take over that role, and there really isn't one right now that could check all of those boxes. So it could be a long time.
And the market basket concept has no more appeal today than it did a decade ago when they started talking about that.
It hasn't really taken off
Yeah.
if you're talking about
Agree.
the
Yes, sir.
special drawing rights.
Right.
But nonetheless, we shouldn't assume that it will last forever, because it won't.
Yes, sir. Thank you for being here. Thank you, Mr. Chairman.
Thank you. Senator Smith.
Thank you, Chair Crapo, and thank you so much, Chair Powell, for being here today. I very much appreciate your service, and I want to just note that I believe in the first 30 seconds of your testimony this morning, you used the word independence. I believe that I heard colleagues on both sides of the aisle pay tribute to how important it is to have an independent Fed, so I want to thank you for that, for your steadfast defense of that. I also want to just quickly follow up on comments that my colleagues, Senator Tester and Senator Schott, said. You know, Senator Tester asked, what is going to tip the scale to bad when it comes to our long-term economic prospects? And I'd like to just, for the record, say that I do really believe that our increasingly volatile climate change is on the same scale as the long-term threats to a growing national debt in terms of the stability of our economy. And trust me, the farmers in Minnesota who are looking at lost yields and a complete shakeup of the world in which they operate, for them this is a short-term and an immediate issue. So I wanted to just add my thoughts to that point. Speaking of issues that are long-term challenges to the economy, you mentioned housing and sort of the lagging housing construction. You know, what we're seeing all over the country, and certainly in Minnesota, is that housing costs are growing faster than wage growth, and the market is producing, so we have shortages of housing at price points that people can afford. And we're seeing, of course, more high-end homes being built, but not homes that people can actually afford. So I'd like to have you just talk a bit more about the impact of this. This has impacts on employment in rural areas, impact on long-term economic prospects for the country, and what you see the Fed's role could be and what our role should be.
So I think what we hear from the home builders is that it's a series of factors that are really holding them back and driving and challenging affordability. And it is in many cases that there was a big home building sector in 2005, and a lot of those people retired in 2007, 8, 9, 10, and 11, and now you have a shortage of skilled labor, so it's hard to get people on the job, electricians, plumbers, carpenters, and other people. That's one issue, just is to get the people, no matter what you pay them, just finding people who can do that work expertly.
Would you say our immigration policy might have something to do with that?
I think that's what we hear from home builders.
Me too.
That's part of it for sure. It's also hard to get lots. You know, we're in many metropolitan areas. You have a lot of homes and traffic and that kind of thing, and the rules for creating new lots are challenging. Material costs too have gone up, and some of that is tariffs, for sure. So the home builders feel almost like they've been hit by a perfect storm here. I think with rates on mortgages having dropped quite significantly over the course of the year, we do expect a turn up there, but these longer run challenges I think are going to be there, and affordability is going to be a challenge.
What I hear from businesses and communities, especially in rural Minnesota, but really all over the state, is that the lack of workforce housing, affordable housing for people who have good jobs, is actually a real limit on economic growth. I'm doing a series of roundtables around the state to try to get at this, so I appreciate your comments on that. Thank you. Let me just ask you on another topic. Senator Shelby was talking about the relationship, or maybe the shifting relationship between interest rates and growth. You are under political pressure, which I don't approve of, to lower interest rates. I'm not asking you what you're going to do, but I want to look at the lesson of what we're seeing in the EU. So in Europe, the central bank essentially has negative interest rates. Economic growth is only about 1.2% a year, and inflation is also below target. So my question is, what can we learn from the experience in Europe? It looks to me, or some could conclude, that you end up losing many tools in your toolbox when you, that seems to be sort of the challenge that they have. Now, obviously, some of this is monetary policy and some of it is fiscal policy, but could you comment on that?
I will, and it's really the same lesson that we've learned, I think, from Japan, that you see that in a less extreme form in Europe, and that is that you don't want to get behind the curve and let inflation drop well below 2%, because what happens is you get into this unhealthy dynamic potentially where lower expected inflation gets baked into interest rates, which means lower interest rates, which means less room for the central bank to react. And that becomes a self-reinforcing thing. We've seen it in Japan, we're now seeing it in Europe, and that's why we think it's so important that we defend our 2% inflation goal here in the United States, and we're committed to doing that.
Thank you. Chair Crapo, I have several other questions that I'd like to submit for the record. I'm especially interested in submitting a question around Deutsche Bank. Last night, the New York Times reported that Deutsche Bank's private banking managers urged the bank to retain Jeffrey Epstein as a client, even after the compliance officers recommended that the bank drop him as a client because of reputational risks. So I'm going to submit a question about what type of customer does represent a reputational risk, and if not Epstein, then who? Thank you.
All right. Thank you. Senator Kennedy.
Thank you, Mr. Chairman. And thank you, Mr. Chairman. Mr. Chairman, what is the economic impact, in your judgment, of illegal immigration on America's economy?
I would have to answer it in generalities. I haven't tried to quantify that, but people who come in legally or illegally, they add to our workforce, and they contribute to GDP, certainly. So that's part of it. I think that part of growth, you can really boil growth down into labor force growth and productivity increases, and immigration, total immigration, has contributed more than half of the growth to our workforce in the last few years. So it's important.
What about illegal immigration? Does it have an impact on wages?
You know, there's been a lot of research on that and has really not reached a clear conclusion. There are research that finds no visible impact, and there's research that finds it has a modest impact.
Well, do you think illegal immigration is a good thing?
You know, it's really not at all in our say-so. It's like trade or guns or some other things that we don't really take part in.
Well, in part it is, and let me explain my perspective. We welcome about 1 million of our world's neighbors to become American citizens every year. I think that makes our country stronger. I think we can probably agree on that. Unfortunately, we have a lot of folks that come into our country illegally. I think part of the reason that so many people want to come to America is because we have rights, and we cherish them and we protect them. I mean, when's the last time you heard of somebody trying to sneak into China? They want to come to America. But with rights go responsibilities. One of our responsibilities is to abide by the rule of law. Federal law is not an a la carte menu. You can't pick and choose which laws you want to abide by. And to come into our country illegally is a violation of federal law. And it would seem to me that we would want to do everything we can, if you believe, as I do, that people respond to incentives, not to give people an incentive to violate the law. Now, that's kind of my perspective on it. Properly vetting people who come into your country, in my judgment, is not racist. It's prudent in the interest of public safety. Are you familiar with the program called Directo a Mexico?
I am not, at least by that name.
I understand it's a program under the Fed. It facilitates remittances from people in America to other countries with low transaction and exchange fees.
This must be part of our ACH operation, and we do some remittance business through our ACH internationally.
Okay. Will you make it easier for people in our country to send money to another country?
Very, very limited. Most of that happens in the commercial banking system, almost all of it, but I think we do, see, we have something called, this is complicated, but automated clearinghouse is really set up to do things like payrolls, and we do that internationally. It's not a great tool at all for sending back remittances.
Okay. But you do have a program, you're just not familiar with it, called Directo a Mexico?
I'm not familiar with it, sorry. I'll look
Okay.
into it.
Do you know if U.S. citizenship is a prerequisite to being able to use the program?
I don't know. I have to check on that.
Do you know the impact of your program on the American economy? What does it do for us?
I'd have to look into all those things, and I'd be glad to do it.
Okay. You're aware that remittances form a huge portion of the GDP in other countries, like Mexico, for example?
Yes, I think a number of countries rely on remittances from relatives who work in the United States and send money back home.
Right. And if someone is here illegally, this program could be an incentive, could it not?
In principle, yes. Again, I am completely unfamiliar with it,
Okay.
so I should really.
That's fair. I don't want to catch you off guard. I'll be calling you. I'd like to visit more about this.
Good.
And whether this is a good idea or whether it improperly incents people to break the law. Okay?
Thank you, Senator.
Thanks for your good work.
Senator Van Hollen.
Thank you, Mr. Chairman, and welcome, Mr. Chairman, and thank you for your leadership. As you know from previous questions I've asked you at these hearings, I've been very frustrated about the lack of the development of a real-time payment system at the Federal Reserve. There were some questions in the House yesterday about this. As you acknowledged, the Fed's been looking at this for 5 or 6 years. In the meantime, every day that goes by, the lack of a real-time payment system is costing millions of Americans lots of money. And over the course of a year, we're talking about millions of Americans losing billions of dollars, especially those who are going paycheck to paycheck. At the same time, other countries, Great Britain, the EU countries, lots of other countries have gotten there before us, and there's no reason we shouldn't have gotten there a long time ago. In the meantime, because of lack of progress, there's been more momentum for a de facto private sector version through the consortium of big banks, the clearinghouse. And there's lots of concerns about that system. Mr. Honig, who was formerly the vice chair of the FDC, and Bruce Summers, formerly at the Fed, recently wrote an editorial about their concerns with the largest banks in the country controlling the payment system. And I just want to quote from their article, and they say, "The needs of consumers and businesses and the depository institutions nationwide that provide them services will be best served by the Federal Reserve continuing to play its role as a payments processor. The alternative, we believe, is to award the clearinghouse a de facto monopoly, resulting in a less competitive and less efficient market for immediate payments." Question: do you share the concerns they expressed in that editorial?
Senator, as you I'm sure know, we actually have a proposal out to provide a real-time settlement system, 24/7, 365, and ask the public to comment on that. We sent it out late last year. We've got several hundred, 900, I think, comment letters and all that. And there's been, this proposal came out of our Faster Payments initiative. We chose to pull people together, as you know.
Not to cut you off, but when do you expect to get this done? I mean, well, again, other countries have done this. It's not that complicated. It's really just a question of making a decision. So do you share the concerns that were expressed by those two individuals in their editorials? And let me, as you think about your answer, I want to point out that 2.5 years ago, when the Big Bank Consortium was preparing to launch a real-time payment system. They told the Department of Justice that they would charge the same price to all depository institutions regardless of their size. About a year later, the Justice Department cited that assurance when it told the clearinghouse that it had no intention to take any antitrust action against them. But last month, the clearinghouse added a big caveat to its pledge. They said that they would only maintain that commitment if there was no other competition, meaning the Federal Reserve. And community bankers are very worried about this. Here's a quote from Bob Steen. He's the CEO of a $93 million asset Bridge Community Bank in Mount Vernon, Ohio, quote, talking about the Fed: "If they don't take that as a dare, then I don't know what it takes for the Fed to serve as a central bank role." So we just got to make a decision here, because the lack of the Fed making a decision is essentially putting in place the de facto clearinghouse. Now, if that's the result of a deliberate decision, that's one thing. But if it's the result of inaction, then there are real risks at stake here.
So we are working our way through the comments and approaching a decision, and we have to weigh this very carefully under the law, under the Monetary Control Act, and under our regulations. You're absolutely right that the smaller institutions are strongly in favor of our doing this, but there's a range of commentary. We have a process we need to go through. We've been going through it, and you know, expect to reach a decision.
All right. I would just be concerned with providing the biggest banks a monopoly over this big an area of transactions. Very quickly, you've indicated how important it is to the Fed to be independent, but the President does give you a call from time to time, right?
He has.
Has he ever raised the issue of Deutsche Bank in those conversations?
By longstanding practice, of course, I respect the privacy of my conversations with any elected official, including the President.
Right. There's no executive privilege, though, between the President and the Federal Reserve, is there?
This is
It's an independent body, right?
That's correct. It's not a legal matter. It's just out of respect for, I would give you the same respect.
Well, we, as you know, a group of senators on this committee have written to you about the Deutsche Bank situation, where senior executives at Deutsche Bank overruled one of their experts who wanted to issue a suspicious activity report with respect to certain Trump entities, financial entities. That was overruled. Deutsche Bank is under your regulatory purview. How can you provide us assurances that that will be looked into when you have a whistleblower case like that?
As you know, we have an enforcement action in place against Deutsche Bank for its system and money laundering issues, and you know, we're providing absolutely standard oversight to that at this time.
Okay. Can you provide us assurances that that kind of situation would come under that purview and investigation?
That kind of situation, yeah.
Thank you, Mr. Chairman.
Senator Jones.
Thank you, Mr. Chairman. And Chairman Powell, thank you for being here, and thank you for your testimony. One of the short-term risks of the economy that I fear, and I think you have highlighted, are the ongoing negotiations in Congress over both government spending and the debt ceiling. In June, the June FOMC minutes, for example, it was written that participants generally agreed that a downside risk was a sharp reduction in government spending. And all told, if Congress doesn't reach an agreement, there's a potential for a $120 billion immediate reduction in federal spending for national security and a host of domestic programs. Would you just elaborate a little bit on what you believe, what kind of risk does this represent to the economy, and how is the Fed processing this risk?
I think that it's essential that Congress raise the debt ceiling in a timely way, by which I mean in a way that allows the United States government to pay all of its bills when and as they're due. That is essential. Any other outcome is unthinkable. We've always paid our bills, and it simply must happen that Congress raises the debt ceiling in time to allow that to happen. The consequences of failing to do so would be highly unpredictable, and no one should assume that the Fed or any other agency can be relied upon to shield our economy from the short, medium, and long-term negative consequences of such an act.
Is there risk in protracted negotiations? I mean, if we're in the 11th hour of discussions, and you know, so many times we have seen, like last year with the government shutdown, with disaster relief, there's all this political posturing, and dueling press conferences, and we end up getting down the road and getting close, and then they fall apart. Is there risk just in that protracted negotiations and waiting till the 11th hour to do something?
I think markets have seen this movie, and I think they think they know how it ends, and so they tend to look through that. You do see some of the Treasury securities that are maturing, they might trade, and they are now trading a bit off because on the theory that there might be some delay in payments, but clearly everyone's assuming that this will get worked out. And if that weren't to happen, that would be, I think, a big surprise and not a good one.
Well, I appreciate your answer. Maybe Congress and the President can take a lesson from that and just go ahead and get it done now instead of going through the protracted, who shot John kind of things and where we are. I want to go back to a question my colleague, Senator Shelby, talked about just a little bit with regard to trade and the apparent progress in trade. And I want to kind of couple that with a little bit with what you've talked about with regard to so many sectors of the economy who are not feeling the buoyancy of their jobs, of their wages, and things like that. Our manufacturers in my state and farmers in my state, I'm not sure they've seen the apparent progress that was initially seen that you talked about, but regardless, they are certainly feeling the pain of the uncertainty. And those challenges are broad in scope. We've got uncertainty with China. There's uncertainty with Canada and Mexico. There are steel tariffs. There are potential auto tariffs. There's retaliatory tariffs on farmers. And yesterday we heard there may be French tariffs, and even our Ex-Im Bank needs reauthorization. That, in my state, that seems to be affecting folks in those rural areas, the African-American folks probably more than most. It has not hit directly the consumer, I don't think, just yet with the tariffs, but it's going to happen. I mean, we're seeing now, we're seeing now that in the short term, we're going to see tariffs that are going to cause increase and a depletion in supply of things like Bibles and artificial fishing lures, which are fairly standard staples in most Alabama households. Can you elaborate for me on which of all of this in particular is the thing that concerns you most about the current situation with tariffs? What are the concerns that you have most? Because we've got them, they're all over the board, and we seem to be going this alone.
I would just say, I think it's general uncertainty on the part of businesses. And that you don't really see that in, as you noted, you don't really see that in household confidence surveys and things like that. I think you do see it in business confidence surveys now. And the concern would be that over time, it will just it will weigh on the economic outlook. And it's a concern. I think we've been hearing that all year long from our business contacts.
In particular, let me ask about, the President right now has on his desk a report from the Commerce Department about whether or not foreign automobiles and suppliers are a national security threat. That has been sitting on his desk since February. It hasn't been released, despite many of us on this panel, including Senator Toomey and I, have been asking. Is the fact that that is sitting there and the President is not even releasing publicly, did that add to the uncertainty?
You know, I'd be reluctant to comment on any particular aspect of trade policy, which is clearly not our job. At the same time, we try to call out the things that we're seeing. We owe that to the public, and so I would just leave it at the level of high uncertainty.
Well, I appreciate the answer. It's really more of a comment from me than anything else. So thank you, Mr. Chairman, so much for being here, and thank you, Chairman Crapo.
Thank you, Senator Jones. And as you can see, Mr. Chairman, we don't have any other senators here, but we have senators coming. So we're in the second vote at this point. Senator Brown will be back in a few moments. He and I are switching out. And while we wait for some of the other senators who want to have a chance to ask you some questions, I get to ask a few more of my own. So I'd like to go back for just a moment to the cryptocurrency issue. And you indicated before, as you start to look at the new Libra proposal, that you have been in communication with some of the other central banks and other regulators, as well as the United States regulators. Are you aware of any other cryptocurrency proposals that are out there, other than Libra, something else globally that is being developed?
I mean, not really. There are companies that are looking at internal stablecoin type ideas to use with their customers, but nothing that, I'm not aware of anything that could potentially be quite so scalable so quickly as this, given the existing network that the company has.
All right, and to return to the question that Senator Perdue had asked you about the impact of a cryptocurrency system on our reserve currency in the world, particularly in the United States reserve currency, which has, as you both indicated in your conversation, I think the United States has benefited from our currency being the world's reserve currency. If a cryptocurrency system were to become prevalent throughout the globe, would that diminish or remove the need for a reserve currency in the traditional sense?
I think things like that are possible, but we really haven't seen them. We haven't seen widespread adoption. I mean, Bitcoin is a good example. Really, almost no one uses Bitcoin for payments. They use it more as an alternative to gold, really. It's a store of value. It's a speculative store of value, like gold. So we don't have, and people, of course, have been talking about this since cryptocurrencies emerged, but we haven't seen it. But that's not to say we won't see it. And if we do see it, yes, you could see a return to an era in the United States where we had many different currencies, and you know, in the so-called, I guess, national banking era.
All right, thank you. I do have more questions, but some of our senators are returning now, and I will turn to Senator Tillis.
Thank you, Mr. Chairman. Chair Powell, thank you for being here. Quick question on payments, maybe a couple of questions. Do you think that the current private sector payment systems are broken?
I wouldn't say they're broken.
Then what part of the problem exists out there that's prompting the Fed to move forward with a payments platform?
Well, we haven't decided to do that, although we do, of course, play an active role in the payment system in a number of ways already. Where the U.S. lags is real-time payments broadly available on an equitable basis. Other countries are way ahead of us on that, and so for the last 5 years, the Fed has been trying to push us. We don't have plenary authority in this area, trying to push us generally into a place where that will be available to people, as it is in many other countries around the world.
How do we go about funding the implementation, the ongoing operation? If you decide to move forward with a Fed payment system.
In anything that we do in the way of a payment service is subject to the Monetary Control Act. Pardon me. And the Monetary Control Act requires that we a couple of things. One is, I won't get the language exactly right, but the sense of it is that it must pay for itself on a basis that is comparable to a private provider, meaning including the cost of capital and taxes.
I'm going to submit, I've got a series of questions that I will submit for the record on the decision process and go forward. But I for one, hope that we can get to a point where perhaps we can facilitate a private sector solution that addresses some of the things that I think you rightly point out, but not necessarily take on that. First off, I should have thanked you for the great work you're doing. I think you're doing great work as chair, and I appreciate.
Thank you.
I appreciate everything that you do in some of the most, I think, confusing times for somebody in your position, and I appreciate it. I think someone mentioned earlier when I was out, I apologize, we've got multiple committees and multiple votes going on right now, but I think that we had some of the folks on the other side of the aisle that are concerned that as Deutsche Bank takes itself apart, that the bigger banks will pick up those assets and maybe even get bigger. But I don't necessarily think that that's going to happen. What I think is probably going to happen is we're going to see that move into private equity where they're probably chomping at the bit to buy things for pennies on the dollar. What's your view?
You know, as you remember, that's exactly the kind of thing I used to spend my time doing. But I honestly have not looked at the company with that with that question in mind. I'll come back to you on that.
Thank you. Another area that I'm kind of curious, if you were in the private sector and you had a 10-year yield that was close to 2%, excuse me, would you extend your maturity profile and lock in financing based on today's market conditions?
I mean, not as a general matter, I think this would be a nice time to lock in, yes.
Yeah.
This is a low rate.
So as we take a look at our own debt, is it time to potentially consider, I know there's some short-term transition costs, but to potentially consider what other countries are doing on longer-term bonds, up to and including, I think more recently, 100-year bonds?
This one is squarely in the wheelhouse of the Treasury Department, who do the debt management. And I know they look carefully, as you obviously know, at doing very long bonds.
You have any view on the pros and cons of doing it?
I really don't. I think they look quite carefully at it. We looked at, when I was at Treasury 25 years ago, we looked at it and concluded that the market there might or might not be a market to do it. So we didn't get it done anyway.
The last thing I'll leave you with, because I want to make sure that the other members get in their questions, is we'll be submitting additional questions for the record for some of my age-old priorities in terms of regulatory work that you're doing, specifically around inter-affiliate margin, Volcker, recalibrating the GSIB surcharge, and a number of other things. We really believe that these are things that are very positive that we need to see progress on. So we'll be submitting questions for the record so that we can see what the progress is and timelines for results. Thank you for being here.
Thank you.
Senator Reed, you ready? Or should I go with Senator Cortez? Senator Cortez Masto.
Thank you. Chairman Powell, thank you. It's good to see you again. And thank you for all the good work that you're doing. At yesterday's hearing, you said that American workers have missed 10 years of wage growth. You said the Federal Reserve needs to do a better job of calling out the declining returns to workers. And you also said more business owners realize that an economy where the richest 1% of families control 40% of the nation's wealth is problematic. And yet you said one answer was for workers to increase their education. And you said this before. I think the last time you were before us, we had this conversation. And correct me if I'm wrong, I'm looking at the Fed's data, and I think it's on page 8. It's on page 8 of the Monetary Policy Report that just came out. If I read this correctly, it shows that wages have barely increased for both high school and lower educated workers and college educated workers. So if you look at that graph, how I'm reading, and correct me if I'm wrong, from 2007 to 2017, wages were basically flat for both. In the past year and a half, wages have gone up by about 1.5% over 2007 levels for both college-educated and high school-educated workers. Am I reading that correctly? So it's been flat for both.
These are real wages after inflation. That's what the trick is here. If you added inflation back in, and nominal wages, of course, have increased.
But for both categories, it's pretty much been flat. There's been a nominal increase for both categories. Is that correct?
So if you look at the table on the right, the picture on the right, what you see is that you had declines in real wages, and then you see them increasing. Around 2015, it became positive for College Plus, and then, but generally speaking, yeah, that's right. Picture.
Yeah, and so would you agree that at least what I see here, that the 1.5 wage increase over a decade is completely inadequate?
I was actually referring to the first decade of this century when I made that comment. So what happened beginning in about 2000, the share of profits going to labor declined. It had sort of oscillated around a particular level for a long time, and then around the year 2000, it went gradually down over a period of 10 years. So my point was, when we talk about wage growth, we're talking about 3% wage growth, which is a pretty healthy level of wage growth. The problem isn't the change; it's the level, in the sense that we missed that period where workers were losing ground in wages against what they would have gotten traditionally. So it's kind of a complicated point, but that's what I was referring to.
So can I ask you this, because you touch on, and I'm going to go back to this idea that somehow increasing one's education will lead to higher wages for them. Do you agree? Because you've said that a couple of times, and I've heard the conversation you had with Senator Cotton as well. Is that something you're saying to address and increase higher wages for individuals, is to ensure that they get a better education? And what do you mean by that?
Well, I think people with higher education tend to have substantially higher compensation in their jobs. The value of a college degree compared to not having a college degree in terms of lifetime earnings is enormous.
Yeah. So, and let me just kind of.
By the way, I'm not saying.
No, and I appreciate that, but here's the problem, the concerns I have with these numbers and these categories. Come to my state of Nevada. High-skilled labor, organized labor, individuals graduate high school, but they don't get a college degree. They go get a skilled, go through an apprenticeship and learn a skill or a trade. And they are making good money, sometimes better than some of the folks that go to college. So what I see in these numbers is not a reflection of the true demographic of who we are as a country. That's my concern. And this idea that we are categorizing people as whether they're low income or high income, I think it's a false narrative. I think people with a high school education can make a good job. They may not be destined to go to a college or university, but they can go through an apprenticeship program. They can be that skilled labor that we need in this country. And it goes back to this issue because you've identified the weaknesses we have of housing, manufacturing, and trade. And I will tell you, housing is the #1 issue in the state of Nevada. Part of that issue is we've lost all the skilled trade because of the downturn in the economy. So we should be investing in those individuals and getting them back to a level where they can go through those apprenticeship programs. And the final thing is with our unemployment market, I do see and I agree with you that because we have low unemployment, that has increased the wages a little bit, because it's forced these companies to say, wow, it's really competitive market now, and I'm going to have to pay more to get more people in. But that should not be the only condition for increasing wages for individuals across this country. And the other thing you need to know, if you don't know, is coming to my state, whether you're a single mother or you're a parent, a two-parent family, these families are working more than one job. I think one job should be enough, don't you? I don't think you should have to work 2 jobs just to be able to make minimum wage. And by the way, a minimum wage at $7 an hour is poverty level. So my concern with these statistics is I want to see you get into the true demographics of who we are as a country and what is going on with these false narratives that I keep hearing, even from this president, that keeps arguing that somehow unemployment for African Americans and Latino is wonderful. And you even show it right here. So I appreciate that it's not. We've got to do a better job. And so that's all I'm asking for. Let's look at the true numbers that we have in this country, because that's the challenge that I see here, and not these false narratives that keep being thrown out there. So I appreciate the hard work you're doing, and I thank you for that. I look forward to working with you in the future, but I ask you and invite you to come in and let's have a further conversation on the data itself.
Great.
Thank you.
Senator Scott.
Thank you, Ranking Member Brown. Chairman, thank you for being here this morning, or now this afternoon, basically. I do want to continue perhaps that current narrative because it does draw my attention. I listened to your testimony earlier this morning. I had meetings in the office and I had a chance to listen to your exchange with Senator Cotton on the labor force participation rate. Frankly, that the labor force participation rate has been ticking up slightly, and one of the reasons why we saw the 3.6% unemployment go to 3.7% is because more folks are coming back to the workforce, which is a positive development. As it relates to the power of education and wages, I was raised by a single mother who had a high school education, and I thank God that she had the skills necessary to support her 2 sons. But one of the things I think we could take away from the numbers specifically as it relates to education is that there is power in education. These numbers that I remember are 3 or 4 years old, maybe 2 or 3 years old, but the person who doesn't finish high school has an average wage around $19,000. The high school graduate has an average wage around $29,000. The person who has a college education has an average wage around $58,000. And if you go on to a postgraduate degree, you have closer to a 6-figure income. So you multiply that over a 40-year work life, the numbers are so drastic and undeniable that without question, consistently speaking throughout this nation, one of the fastest ways forward is in fact education. Your comment, do you agree or disagree with that?
No, I totally agree with that, yeah.
Well, your comment with Senator Cotton that got my attention was that a part of the challenge that we have with upward mobility in our society, which I think you pinned or put the focus on education, is the importance of understanding globalization and technology and the chasm that it creates in our workforce for those who, on one side, are going to be detrimentally impacted by this growing technology and technological gap that's being created. This gig economy requires perhaps even a different type of education. So it may not be the formal education that we're all used to in those figures that I talked about, from the high school dropout to the person with an advanced degree. That still works. In addition to that, one of the reasons why myself and Cory Booker and others have focused on apprenticeships is because our nation, comparatively speaking to someplace like Germany, we are woefully behind on using apprenticeships as a mechanism or vehicle to help those folks who may not want the four-year track to still achieve the type of income that Senator Cortez Masto wants for her constituents and I need for mine as well. Is that an accurate depiction of the comment with Senator Cotton around globalization and technology and the importance of education?
Yes, and I would just say education, for me, is a shorthand term that includes things like apprenticeship programs and trade schools and things like that. It just means things that enable you to get skills and aptitudes and succeed in the economy.
So in a technologically advancing society, a lifelong learner will do better than one who's not.
Absolutely, absolutely, yes.
Pat Toomey talked about the Goldilocks economy, which I thought was, I like the term. Sometimes I want to compare that against the woe is me economy that we seem to hear a lot about. I have a question as it relates to the number of Americans who actually work multiple jobs. My understanding is that it's somewhere around 7 to 8% of Americans have more than one job, 1 in 15. I read an article recently in the Wall Street Journal that said the number was closer to 5%. Can you help me understand what is the number? Is there a way for us to discern?
Yes, we can run that number down for you.
Okay. Is it less than 10%?
I don't know.
Okay.
But I think there's a way to know that. It may be just the difference between the household survey and the establishment survey. We can get that number for you.
So I think it's important for the American people to understand and appreciate what the number is and how many folks are actually working more than one job. I think both sides of this aisle have a strong passion to make sure that upward mobility is in fact still alive and well and a part of the American dream. And a part of that American dream is being able to achieve a standard of living that is comfortable without two jobs. It would be important, I think, to both sides for us to A, figure out what the number is, B, see if there are solutions, be it being a lifelong learner or the standard college track. I would love to have more information on that. My final thought is on trade. You've answered the question on trade. You've been very clear on what your role is and what your role is not. When you look around the world, GDP activity is tough, whether it's Japan at 0.6% or the UK at 0.4%, Germany's at 0.5%. That plus tariffs and this trade volatility, how does that impact a state like mine where 1 in 11 employees are connected to the exports of our nation, of our state?
Well, I would guess that those companies and people are feeling that weak global growth and uncertainty around trade are weighing on their outlook. And currently, things are okay, but businesses are beginning to hold back on investment. For example, we see business investment having weakened after having been quite strong in 17 and most of 18. Business investment is critical. It's really slowed down here, and one of the reasons is uncertainty around trade and global growth.
Thank you.
Thank you.
Thank you, Mr. Reagan.
Senator Reid.
Thank you very much. Thank you, Mr. Chairman. I apologize. We had the hearing for the Chairman of the Joint Chiefs of Staff simultaneously, so forgive my late arrival. Mr. Chairman, how much economic uncertainty has the President delivered as he constantly moves the goalposts with tweets about trade, about the debt ceiling, about multiple issues? Does that help?
So I wouldn't comment on trade policy as though we were responsible for it. We don't comment on it in any way. I will say that trade policy uncertainty, as you can see from one of our charts in the monetary policy report, is quite elevated. And many U.S. manufacturing companies have supply chains that reach across national borders around the world, and those companies are facing an uncertain situation. A natural thing to do is to hold back, and so I think we're seeing some of that, and not making investments and that sort of thing. So,
And there is a correlation between the day-to-day tweets, comments, advances, the movements that the president.
what we've been hearing really for more than a year now is uncertainty going up and down, and it went up quite a bit in May. May was a real month where we saw trade uncertainty spike around various events, and I think that'll show up in the data.
The economy is doing well, but why does Wall Street expect you to cut rates? Typically in a booming economy, rates are either stable or go up.
Well, we do see an economy that's in a good place, but what we see is a number of things that are weighing on the outlook. I mentioned global weakness. Around the world, you do see really weak economic performance. You see that in Asia, you see it in Europe, and you see central banks beginning to address that by providing more accommodation. And we see that as a downside risk here in the United States. We also see subdued inflation. We're in our 11th year of this expansion, I'm happy to say, and we're at 3.7% unemployment. We've been there for 15 months, and yet inflation is below our target. So I think many of my colleagues on the FOMC have come to the view that a somewhat more accommodative monetary policy may be appropriate.
Let me just change this topic to one issue of importance, I think, to all of us, and that is recently, more so than the past, the independence of the Fed has been questioned, and even your role has been questioned. And as the Federal Reserve's own website points out, your policy decisions have to be based on data and your judgment, not political pressures that could lead to undesirable outcomes. So what are some of those undesirable outcomes that would be produced if, in fact, the Fed became less independent and more adjunct to political motive forces?
We have a pretty narrow set of protections that amount to what we call our independence, and we think that those institutional arrangements have served the public and served the economy well over a period of time. What we see in countries or in eras in the United States when those protections are not in place is we've seen bad outcomes happening, in particular the high inflation that the United States experienced in the 60s and really in the 70s. Was a failure on the part of the Fed to do what needed doing. Paul Volcker came in and did it. It was incredibly unpopular, as you'll recall, but it really put the United States in a great place for really for a long period of time having inflation under control. So those are the kinds of things.
Right. But I think that comes back to my initial question, which is, the agitation by the president for lower interest rates to keep the economy going is as much political as its monetary policy. Does that influence your decision to lower rates?
Not at all. I would want the public, it's critical that the public understand that we are always going to do our work objectively, based on data, with transparency, and we're going to do what we think is right for the U.S. economy. That's what we're going to do, and that's what we're always going to do.
So that with data, you're prepared to raise rates if necessary?
Absolutely. We'll do what we think is right.
Thank you. Just a final quick question, and only someone who was here for the Sarbanes-Oxley legislation would ask, is that the Federal Reserve banks are subject to several levels of audit and review, and the Reserve Bank's financial statements are audited by independent public accountants retained by the Board of Governors. The question is, do you believe it's important for the Board of Governors to know whether the auditor has been disciplined in the past for poor performance before you select them?
It is important, and we do demand all relevant information on that question, including just about any kind of a question that's been raised. We get that information before we make a hiring decision.
Thank you, Mr. Chairman. Thank you for your service.
Senator Brown would like to ask another couple questions, and then we'll be done, Mr. Chairman.
Thank you. Thanks for your patience. And as you sit through this, Mr. Chairman. I have two brief questions and then a short statement. During the debate of passage of S-2155, we repeatedly heard from the Fed and the sponsors of the bill that Section 401 would not weaken the prudential standards in foreign GSIBs operating in the U.S., yet the Fed released an implementing proposal in April that appeared to do just that. What led to that about-face?
I think that proposal is just a matter of providing national treatment to banks that do business in our country. We try to treat similar banks similarly, whether they're foreign banks or U.S. banks. And we expect the same for our banks in foreign countries.
I understand, Mr. Chairman, that's the argument for it now, but it's not what we were hearing from many people prior to this. Because we made the argument this could increase systemic risk, and they either consented to that belief but then seemed to change their minds. You all seem to change your mind after this happened, but I'll leave it at that. A couple other things. The last financial crisis was caused in part by huge financial institutions, Wall Street banks, that largely were given free rein to take big risks with entire sectors of our economy. As Senator Warner said, taking advantage of, he termed it, taking advantage of gaps in the regulatory system. You've raised concerns about the ability to regulate Facebook, that what would be the best, and I would like to ask you, what would be the best, most effective way to regulate a complex internet-based company like Facebook with billions of users and a digital currency based on a Swiss bank account? How will you look at doing that?
It's a question we're just beginning to address. We certainly don't want to regulate their social media, activities. That's not at all something we would have any interest in. But and I don't know what the right way to get at this is, but I do think that this is a question we're going to have to get our arms around. It's the reason we're working on that now.
Okay. Listening to your comments, both Senator Scott's comments and Senator Cortez Masto, both the interactions that you had with each of them, I want to just, and this is not a question, I just want to make a point about how important this is. That we know that unemployment rates for African Americans and Latino Americans workers are consistently higher than those for white workers. One economist, Algernon Austin, said the experience of Black America is one of permanent recession. One of the benefits of aggressively pursuing a high employment economy is that job opportunities improve substantially for workers who face the largest barrier. You said a few minutes ago, that waiting 8 years for that in a recovery is just simply not acceptable public policy. You're, of course, right about that. Go on to say the black rate of unemployment in the best of times is not much better than the white rate in the worst of times, the economic situation of workers. So you had talked about subdued inflation, and I think we miss opportunities when there seems to be, I don't think I've seen that in you, I've seen it in the past, a bias towards fighting inflation over fighting unemployment. And I think this disparity in unemployment rates between white workers and workers of color is another strong argument for weighing the benefits of a high employment economy and assessing maximum employment, especially with the likelihood of an outbreak of unacceptable inflation as it remains remote. So I hope you'll keep that focus as you think about interest rates, as you think about your role in this economy.
Thank you.
Thank you, Chairman Powell. I told you those were the last two questions, but Senator Brown's question about Senate Bill 2155 has prompted me to ask a follow-up. I think this is self-evident, but I just want to be sure and let this be made a part of the record. The proposal that the Fed is looking at right now in terms of how to treat foreign banks or the subsidiaries of foreign banks that operate in the United States will not introduce systemic risk or increase systemic risk, will it?
No. No, these are, remember, they only apply to the U.S. Entities, and they're not of that size or caliber.
And it's the same standards that we apply to our U.S.
Our own, that's right.
Our U.S. banks.
That's right.
Did you want to follow up on that at all? All right. We'll debate this between ourselves later. That's right. Well, Chairman Powell, thank you again for being here with us today. That concludes our questioning for the hearing. For the senators who wish to submit questions for the record, those questions are due to the committee by Thursday, July 18. We ask you, Chairman Powell, to please respond to those questions as promptly as you can. With that, again, thank you for being here, and this hearing is adjourned.
Thank you.